The rally looks clean on the surface. The S&P 500 has come back sharply. The Nasdaq has almost completed a full V-shaped recovery. Bitcoin has recovered from the mid-60s and moved back toward 80,000. If you only look at the chart, it looks as if the problem has passed. The system has absorbed the shock, and investors have decided that risk is safe again. But that is not how I look at markets. When I look at a rally like this, I do not begin by asking whether prices have gone up. Prices are the output. I begin by asking what the machine is discounting, what assumptions are embedded inside the price, and where the assumptions can break. Right now, the market is responding to relief. The extension of the ceasefire between the United States and Iran has given investors permission to breathe again. The market was pricing the possibility of a broader global shock, and when that shock did not immediately arrive, capital moved back into risk assets. Stocks rose, Bitcoin rose, large technology names were bought again. Artificial intelligence enthusiasm came back with force. That is understandable. But understandable does not mean resolved. The Middle East risk has not disappeared. Oil has not returned to a calm, low-risk environment. The Strait of Hormuz is still one of the most important transmission points in the global economy. If energy supply is threatened, oil rises. If oil rises, inflation pressure rises. If inflation pressure rises, the Federal Reserve has less room to ease. If the Fed has less room to ease, liquidity becomes more fragile, and if liquidity becomes more fragile, the entire risk asset rally can change character very quickly. That is the cause. An effect chain. Most people see only the first link. They see prices going up, and they conclude that safety has returned. I do not. I ask whether the underlying system has become safer or whether people have simply become more willing to ignore the risks for a while. There is a big difference between those two things at the same time. Corporate earnings have been strong enough to support the rally. Large companies have continued to produce profits. The biggest technology companies are still spending enormous amounts of money on artificial intelligence infrastructure. The market believes the AI cycle is not finished. It believes this is still one of the most powerful productivity waves of our lifetime. I agree that AI is one of the most important forces in the world economy, but I do not confuse a true long-term force with a straight-line short-term investment outcome. Big ideas often create big wealth, but they also create violent overreactions, crowded trades, emotional buying, and deep corrections. The internet was real in 1999. That did not prevent the market from destroying people who bought the wrong companies at the wrong prices. Artificial intelligence can be real and still produce periods where investors get punished for confusing the future with the price already in front of them. That is one of the first principles of markets. Something can be true and still be badly timed. The rally we are seeing now is not an everything is fixed rally. It is a relief rally. It is the worst case scenario has not happened yet rally. It is also an earnings rally. It is an AI momentum rally. And in crypto, it is partly a liquidity and belief rally. Those are not bad things. They are simply different things. When investors forget the distinction, they become vulnerable. I have seen this pattern many times. Markets fall because fear becomes dominant. Then markets rise because the fear does not fully materialize. Then people who were cautious begin to feel foolish. They rush back in. The same people who wanted a 20% correction suddenly chase a 10% rally. The same people who said they would buy the dip begin to freeze when the dip arrives and then buy when the pain is gone. Human beings are not built to invest well by instinct. Markets are systems that punish instinct. They punish greed when greed becomes too aggressive. They punish fear when fear becomes too paralyzing. They punish overconfidence when people think one headline has solved a complex set of risks. And they punish inaction when people wait forever for the perfect entry that never comes. That is why I do not believe the answer is to sit entirely in cash and wait for certainty. Certainty is usually expensive. By the time everything feels safe, the market is usually moved. By the time every risk has been explained away, the opportunity is often smaller. If your objective is wealth accumulation over many years, and if you believe the world economy will be larger 5 or 10 years from now, then being completely out of the market because you want the perfect pullback is usually a mistake. But the opposite mistake is just as dangerous. Throwing all of your capital into the market because prices are rising is not investing. It is emotional reaction. It may work for a while, especially in a momentum-driven environment, but over time it makes you dependent on luck. And luck is not a strategy. The better approach is systematic. You buy over time. You build positions gradually. You preserve cash, so that when volatility comes, you have the ability to act. You do not wait with all of your capital on the sidelines, but you also do not spend all of your firepower on the first rally. You accept that markets spend more time rising than falling, but you also understand that the falling periods create the best entries for people who are prepared. That is the balance. People often ask whether they should buy now or wait for a bigger correction. I think that is usually the wrong question. A better question is, what is your system for allocating capital under uncertainty? If your system requires you to know the next short-term move, it is not a good system. A good system works because you do not know. You dollar cost average into the areas where you have long-term conviction. You keep cash reserves for the moments when fear creates better prices. You concentrate only where you have done deep research. And you diversify where uncertainty is high. You do not confuse a watch list with a portfolio. You do not confuse a narrative with a thesis. You do not confuse volatility with risk, unless volatility can force you to sell. That is how I would think about this environment. Now, there are several major variables that matter more than almost all the daily noise. The first is the situation with Iran. Markets are reacting to every headline because the risk is tied directly to energy and global confidence. The United States wants to prevent Iran from expanding its nuclear and missile capabilities, and it wants the Strait of Hormuz to remain open to oil traffic. Iran wants sanctions relief, leverage over the region, control over its own security position, and greater freedom to continue its program. These objectives are not easily reconciled. That means the most likely outcome is not a clean resolution. The most likely outcome is a messy middle. A messy middle means negotiations continue in the background. There are flare-ups. There are isolated incidents. The blockade risk remains. Neither side fully escalates to the worst-case scenario, but neither side fully backs down either. This is the kind of environment where markets can rally for weeks and then suddenly sell off on one new event. It is also the kind of environment where investors who react to every headline lose their emotional balance. You do not need to predict every move. You need to understand the range of outcomes. The second variable is oil. Oil is the fastest transmission mechanism from geopolitical risk into the real economy. When oil goes higher, it does not stay isolated in the energy market. It moves through transportation, it moves through shipping, it moves through food, it moves through manufacturing, it moves into consumer expectations, and eventually it moves into inflation data that matters. Because inflation controls the Fed's room to maneuver. If oil cools down, the market can continue to believe in rate cuts, easier liquidity, and rising risk assets. If oil stays high, inflation pressure remains. If inflation pressure remains, the Fed cannot become as dovish as investors want. And if the Fed cannot become dovish, the market has to price a world with less liquidity than it wants. That is the chain. This is why I pay attention to oil more than many stock investors do. Oil is not just a commodity in a fragile macro environment. Oil is a signal about the cost of the system. The third variable is inflation. Inflation is not just higher prices. Inflation is a redistribution mechanism. It moves purchasing power from people who hold cash to people who own assets that can reprice. It reduces the real value of fixed debts. It changes how households behave. It changes what the central bank can do. It changes the relative attractiveness of every asset class. If inflation stays contained, markets can continue to look through the noise. If inflation accelerates again, especially because of energy, then the market will be forced to reconsider the path of interest rates. Markets do not wait for the actual rate cut, they move. When the probability of the rate cut changes, that is why even a small change in inflation expectations can move prices dramatically. Investors are not just buying earnings today, they are buying the future liquidity path. And when that path changes, valuations change. The fourth variable is corporate earnings. This is the part many pessimists miss. Markets can rise in an uncertain environment if earnings are strong enough. A company that keeps growing revenue and profit through chaos proves something important. It proves that it has pricing power. It proves that demand is durable. It proves that its business model has resilience. In every era of disruption, the best companies become stronger because weaker competitors get squeezed. That is why earnings matter so much here. If the S&P 500 continues to deliver strong earnings growth, the market can absorb a lot of bad headlines. If earnings begin to crack while oil is high and inflation is sticky, the risk changes dramatically. Then the market would not just be dealing with a macro problem. It would be dealing with a fundamentals problem. The fifth variable is artificial intelligence. Optimism AI is the story that keeps pulling capital back into the market. It is the reason investors keep buying the dips in large cap technology. It is the reason semiconductors, cloud infrastructure, power demand, data centers, robotics, automation, and software companies are being treated as parts of a much larger transformation. I think this transformation is real. But I also think that people need to separate the technology from the trade. The technology can change the world. The trade can still be overcrowded. The technology can create trillions of dollars of value. Individual stocks and tokens can still go down by 50% if expectations get ahead of reality. You need conviction, but conviction without risk management becomes arrogance. AI also creates a deeper social and economic issue. If AI continues to improve at the speed many of the leading entrepreneurs believe it will, then a large part of the labor market will eventually be disrupted. People who believed their jobs were safe will discover that a machine can do part of their work faster and cheaper. Governments will be forced to respond. We are already hearing powerful people talk about universal basic income, universal high income, or some version of direct support because they understand that the old employment structure may not be able to absorb the technological shock. Whether this future is 5 years away, 15 years away, or longer, the principle is the same. If the people building the machines are preparing for a world where labor is less secure, then the people who only own labor must prepare too. That does not mean panic, it means ownership. If you do nothing, you risk becoming only a consumer in someone else's system. You depend on wages that may be pressured by automation. You depend on government payments that may not preserve purchasing power. You rent from people who own productive assets. You buy products from companies that own the platforms. You watch the world change while your position in the system weakens. If you prepare, you own part of the system that is changing. You own assets, you own equity, you own scarce digital or hard assets if they fit your risk profile. You own claims on productivity. You build the ability to think, allocate, and adapt. You do not need to control the whole machine, but you need to stop being only a person the machine acts upon. This is why financial education matters. Money is not the purpose of life. Money does not solve every problem. It does not create meaning by itself, but money changes your options. It affects the neighborhood you live in, the schools your children can access, the medical care you can afford, the risks you can absorb, and the dignity you have when the world becomes unstable. That is why I take it seriously. When I look at the current market, I see a world where most people are suffering from information overload. In the past, retail investors did not have enough information. Today, many people have too much. They have charts, podcasts, newsletters, AI summaries, social media threads, exchange data, on-chain data, earnings transcripts, macro updates, and 1,000 confident strangers telling them what to buy. The problem is no longer access, the problem is filtering. If you cannot filter, more information makes you worse. It creates paralysis, it creates emotional overtrading. It makes you chase every green candle and fear every red candle. You become reactive instead of strategic. The job of an investor is to identify what actually moves the needle. Right now, I would focus on the 5 variables I just described: the geopolitical risk, oil prices, inflation and rate expectations, earnings, and the durability of the AI thesis. If a headline does not change one of those variables, it is probably noise. If it changes one of them, it matters. This simple filter prevents you from living as a prisoner of every notification on your phone. That is a practical discipline. Now let me talk about asymmetric opportunity, because this is where people become either very wealthy or very damaged. An asymmetric opportunity is not simply an asset that can go up a lot. Many things can go up a lot, that is not enough. A real asymmetric opportunity has several forces lining up at once. It has a strong narrative before the crowd fully understands it. It has a path for liquidity to enter. It has a price that does not yet reflect the full potential. It has a reason attention will move toward it. It has a catalyst. And ideally, it has a downside that can be managed. That combination is rare. When I study past big winners, I do not just look at the chart after the fact. I ask what the signal looked like before the move. What did the strongest investors see early? What narrative was forming? Where was liquidity beginning to flow? What part of the story was still not priced in? What would have invalidated the thesis? That is how you build a repeatable process. One example from the crypto world was the Base ecosystem trade. Coinbase had signaled a much larger plan to bring people onto its network and expand financial products on chain before the broad market fully appreciated the opportunity. There were assets positioned to benefit from that flow. The key was not merely buying something because it was cheap. The key was seeing the connection between a large platform, a new ecosystem, the liquidity path, and the asset that would capture the most direct upside if the thesis played out. That is a framework. Narrative alone is not enough. Price alone is not enough. A good chart alone is not enough. You want narrative, liquidity, timing, relative strength. An upside to converge when something refuses to fully die during fear. I pay attention. Relative strength does not guarantee success. but it tells you something about demand. If an asset holds better than expected when the broader market is weak, somebody may be accumulating. If an asset keeps rejecting the same downside level, that can be a signal. If attention has not arrived yet, but the fundamentals are developing, that can be the beginning of an opportunity. But this is also where discipline matters most. You do not simply buy everything that is green. You do not chase every token or stock that moves. You build a watch list. You study, you wait for alignment. You decide your invalidation point before you enter. You size the position so that you can survive being wrong. The goal is not to be right on every trade. The goal is to structure your decisions so that your winners are large and your losers do not destroy you. Selling is often harder than buying. People think the hard part is finding a big winner early. That is hard. But once the position goes up, psychology becomes even harder. Greed whispers that it can go higher. Social media tells you never to sell. Your identity becomes attached to the trade. You stop managing risk because the profit feels like destiny. Then the cycle turns and the paper wealth disappears. That is why a plan is necessary before the euphoria. If you do not decide how you will take profits before the market becomes euphoric, the market will decide for you. Now, let me walk through how I would think about the categories mentioned in the original market setup, keeping the same logic but through a more principled lens. Bitcoin remains the core crypto asset for many investors because it is the most established, most liquid, and most institutionally accepted asset in that ecosystem. The thesis is simple. If people continue to look for assets outside the traditional currency system, if institutions continue to adopt the vehicle, and if scarcity remains central to the story, Bitcoin continues to have a role. But Bitcoin is volatile. A person who cannot handle a large drawdown should not pretend they can just because the chart looks exciting. If Bitcoin is above key levels and the thesis remains intact, gradual accumulation may make sense for someone with the appropriate risk tolerance. If it drops into deeper value zones, that can be an opportunity for people who have cash conviction and discipline. But if you are using leverage without experience, you can be correct on the long-term thesis and still lose your money in the short term. That is the danger of leverage. Leverage turns volatility into a survival problem. The next category is the higher upside crypto infrastructure trade. In the source thesis, Hyperliquid is presented as a high conviction example because it is not merely another speculative token. It has exchange activity, fee generation, liquidity, perpetual markets, and a mechanism where a large portion of revenue is tied back to the token through buybacks. It is also expanding beyond only crypto pairs into commodities, indexes, and equity. Like exposure on chain, that matters because the strongest crypto infrastructure assets are not only stories, they are rails. If a protocol becomes a venue where people actually trade, borrow, hedge, speculate, and move capital, then its value can become linked to activity rather than only belief. That does not make it safe. It makes the thesis more measurable. You can watch volume, you can watch fees, you can watch total value locked, you can watch market share, you can watch whether users return when the market becomes active. Again, that is different from a token that only survives on hype. The concern is decentralization and structural risk. If a network is too centralized, then credible neutrality becomes an issue. If a few validators control too much, then long-term trust may be challenged. If regulation changes, if security fails, if volume migrates elsewhere, the thesis can weaken quickly. So the question is not whether the story is exciting. The question is whether the economic engine is real, whether the risks are understood, and whether the sizing reflects those risks. Then there are equity wrappers or treasury vehicles connected to crypto assets. These are attractive to some investors because they allow traditional market participants to gain exposure without directly holding the token. But they are also more complex. You have to understand net asset value, premium or discount, management incentives, dilution, liquidity, treasury strategy, and whether the vehicle actually creates value or simply repackages exposure. A treasury company can become powerful when it holds an asset that appreciates and when it can access capital cheaply. But it can also become dangerous when the premium collapses, when dilution hurts shareholders, or when the underlying asset falls. This is not a simple trade. It requires understanding the wrapper, not just the asset inside. MicroStrategy is another version of this logic. It is effectively a public equity vehicle with leveraged exposure to Bitcoin. If Bitcoin rises significantly, it can outperform. If Bitcoin falls or if the financing structure becomes stressed, it can underperform violently. People who buy it because they want more upside must also accept that they are buying more risk. There is nothing wrong with that if it is intentional. There is something very wrong with it if the investor does not know what they own. Then there is the mecha coin category, where the original script points toward a specific consumer, facing token thesis. I view that entire category differently from infrastructure or Bitcoin. Meme coins are primarily attention assets. Their value is driven by community, brand, liquidity, exchange access, timing, and the madness of retail participation. They can produce enormous returns. They can also disappear faster than rational investors expect. The only way to participate in that category responsibly is to admit what it is. It is not a core investment in the same sense as a profitable company or a productive infrastructure asset. It is a high volatility attention trade. That means position size must be smaller, exit rules must be clearer, and you must never confuse community enthusiasm with permanent value. In every cycle, there are a few winners and many losers. Your job is not to believe every story. Your job is to survive long enough and be selective enough to capture the rare one without being destroyed by the many. There are also Ethereum and Solana, related treasury or leveraged plays. The same logic applies if you believe that another layer 1 or smart contract ecosystem will benefit when risk appetite returns. Then exposure can be structured through direct assets, related equities, or treasury companies. But the additional layer of complexity introduces additional risk. The more wrappers you add, the more you must understand. Many people get hurt because they want the upside of sophistication without doing the work of sophistication. Markets do not reward that for long. The broader principle is this. In a high volatility environment, you want a combination of core exposure, asymmetric exposure, and cash flexibility. The core exposure keeps you in the long-term trend. The asymmetric exposure gives you the possibility of outsized returns. The cash flexibility allows you to act when prices become favorable. If you have only cash, you may miss the upside. If you have only risk assets, you may not survive the drawdown. If you have only speculative assets, one wrong cycle can erase you. Balance is not weakness. Balance is what lets you stay in the game. One of the best signals in markets is when people stop paying attention. Retail attention often arrives late and leaves early. When markets are boring, difficult, or emotionally uncomfortable, most people disappear. They stop researching. They stop building watch lists. They stop learning. Then after prices rise, they return and call it opportunity. That is backward. The work should be done when the market is quiet. The entry should be prepared when attention is low. The selling plan should be written before the crowd returns. If you wait until everybody is excited, you are probably not early anymore. This is true in stocks. It is true in crypto. It is true in real estate. It is true in every cycle I have studied. The crowd is not always wrong, but the crowd is usually late. That is why the present moment matters. The market has recovered, but risk has not disappeared. AI is accelerating, but the trade is not risk. Free crypto has upside, but the cycle is more difficult than earlier cycles. Retail investors are smarter now, liquidity rotates faster, and the easy money of prior cycles may not repeat in the same form. That means investors need better systems. They cannot simply buy everything and hope. The old environment rewarded broad speculation when liquidity was enormous. The new environment may reward selectivity. Money may rotate from one narrative to another, one asset to another, one sector to another. The winners may be powerful, but the window for each may be shorter. That makes planning more important. When I think about the next several years, I believe the high-level direction of markets is still upward because human productivity, technology, monetary expansion, and the incentive structure of governments all point in that direction over long periods. But within that long upward path, there can be brutal corrections, there can be recessions, there can be policy mistakes, there can be wars, there can be inflation shocks, there can be liquidity squeezes, so I do not plan around a single prediction. I plan around multiple probabilities. If markets go higher, I want exposure. If markets fall, I want cash and a list of assets I understand. If inflation rises, I want assets with scarcity or pricing power. If AI continues to accelerate, I want exposure to the productivity layer. If crypto risk appetite returns, I want exposure to the strongest liquidity and infrastructure plays, not just random speculation. That is a portfolio thinking approach. The final piece is psychological. You need something that keeps you grounded in the original source. That grounding comes from faith. In my own language, I would say every investor needs principles. A person without principles becomes reactive. They become a slave to markets, headlines, and other people's emotions. Principles are what you use when the environment becomes confusing. A principle might be, I do not invest money I need in the next 12 months into high volatility assets. A principle might be, I always know my downside before I think about upside. A principle might be, I never use leverage unless I know exactly what would force me out. A principle might be, I build conviction through research, not through excitement. A principle might be, I take profits when the crowd becomes certain. These principles sound simple, but in the middle of a cycle, they are difficult to follow because your body will tell you to do the opposite. When prices are falling, your body will tell you to run. When prices are rising, your body will tell you to chase. When everyone is laughing at caution, your body will tell you to abandon discipline. When everyone is terrified, your body will tell you to abandon opportunity. That is why principles matter. They keep you steady. The biggest changes of our generation are not coming slowly in a way that makes everyone comfortable. They are coming through AI, automation, debt, currency debasement, geopolitical conflict, crypto infrastructure, energy constraints, and a new kind of market behavior where narratives move at digital speed. You can either be overwhelmed by that or you can build a system for it. The system is not complicated in theory. Stay invested in the long-term direction of productive assets, preserve cash for volatility, study the few variables that actually matter, build watch lists before attention returns, look for asymmetric opportunities only when narrative, liquidity, timing, and valuation align size positions so you can survive. Take profits when the risk-reward changes. And above all, do not let fear or greed become your investment manager. That is how you put yourself on the right side of a changing world. Not by predicting perfectly, not by chasing every opportunity, not by hiding in cash, but by preparing, thinking in probabilities, and acting with discipline when the system gives you a chance. Most people will not do that. They will wait for certainty, they will chase after the move, they will confuse content with research, they will confuse excitement with conviction, they will panic when they should be studying, and become euphoric when they should be reducing risk. You do not have to be one of them. The opportunity is not gone yet, but it is not free. It requires patience, it requires work, it requires clarity, it requires the ability to sit through volatility without losing your mind and the humility to know when you are wrong. Generational wealth is not built by reacting to every headline. It is built by understanding the machine before the crowd does, owning the right pieces of it, and staying disciplined long enough for the world to move in the direction you already prepared for.